Thank you so much for entrusting me with your time and with your attention. So we're going to get started. So let me just introduce this session that we're going into. This is the Masterclass forms of SME, forms of financing for SME growth. My job today is to make sure that I am distilling all the complexity that's associated with finance and makes it as simple as possible for yourself to digest and for yourself to utilize in the growth of your SMEs. If you walk away from this masterclass more confused about finance than you were before, then I've not done a good job. So I'll do my best to be as cogent, as clear as possible. So let's do this. Oops, what's the next page? There we go. So a little bit about myself. My name is Jito Kayumba. I am your facilitator for the day. It's a huge privilege to be invited by Prospero to speak on this matter. I happen to be part of a venture capital fund called Kukula Capital. I'm a partner. I'm involved mostly in the deal origination side, on portfolio management, on governance, and investor relations. And that's the reason why I've come to know quite a bit about SME financing, because we've been privileged to invest in a good number of SMEs, many of whom have grown to be quite successful. The other side of me is that I'm a corporate director. I sit on a number of boards, both publicly listed boards as well as private companies, also understanding the intricacies of those particular businesses across the continent, in South Africa, Kenya, as well as in the UK, and of course in our beloved Zambia. The last thing about me is I am a defiant African. And what that means is I look at the world, I look at Africa not for what it is, but more for what it can be. And define, the reality, which is, wrought with poverty, difficulty, struggle, that, SMEs investing, building businesses is ultimately all change the narrative of Africa. And this is why this subject is so dear to my heart. In the top right corner, you see a little icon there for Drip University. I have a lot of fun with people on Twitter and other platforms in sharing a few insights on life, on entrepreneurship and personal development. So that's what that's all about. Now, as we move into this particular subject matter, I need to touch on not only, the existing forms of existing options that many people are aware of when it comes to financing their businesses, but also the alternative ones that are hardly utilized, that haven't been around for a long time, particularly in the Zambian market. And we'll move into really understanding the pros and cons, and then concluding on how do we tick the boxes? How do we become, positioned to access finance or take advantage of various options when it comes to accessing finance? I've seen a notification in the message box just in case there might be an issue. Okay, good. Just confirmation that you can hear me. Thank you so much. All right, existing forms of finance. Let's go into it. The known sources. We all know commercial banks. We've grown up seeing them. We all know micro lenders, loan sharks, and the 3Fs, right? These are just generally what most people know, and I'll touch on them quite briefly. I don't need to go into detail because of the fact that what I'm trying to now establish is really a mindset where when you look at a bank and you look at some of these other options that currently exist, first of all, I need to demystify something. A lot of people have the misconception that some of these institutions won't lend to SMEs for reasons that are beyond some of the things I'm going to share with you. Of course, banks are interested in making a yield of what they lend you. And this really brings me to the point of every entrepreneur needs to understand that these financial institutions are partners. They're looking to make a yield of your business, of your cash flow. So when you have a mindset of where they're looking for growth, where they're looking for gains, then you're somewhat aligned in ensuring that what you are submitting in terms of applications are meeting their expectations and meeting their objectives. And then obviously it's a win-win, right? So banks generally are involved in the business of lending, and that lending results in them, of course, charging interest that you pay. That is part of their business model. Now, on your side of things, the expectation is naturally that you need to have positive cash flows or cash flows that can cover their expectations. And having that clarity is very important. And how do they mitigate risk? Mitigating risk really comes with ensuring that there's collateral, which is security, something that you pledge in the event that there's a default, because they need to essentially cover themselves because of the fact that they're managing money on behalf of others. And this is the same for micro lenders. The only difference is micro lenders tend to lend a lot less money, but they do it in a much shorter turnaround period, and are less stringent than commercial banks. Now, many of you may also be familiar with loan sharks, right? I mean, obviously in our communities, we hear of Kalova and this and that. I mean, these are typically individuals who will lend you at an exorbitant interest rate. They're almost like your last sort of source if you're in a desperate situation. And, of course, I wouldn't even want to touch that if I was an SME. I mean, ultimately, your goal should, if you're going to get funds from these existing sources, you can either work with micro lenders or commercial banks. The 3 Fs is usually how most people get their businesses started. This is a bit of an inside joke within the private equity space. Whenever we talk to people like, who funded you in the beginning? Which of the 3 Fs funded you? Usually it's friends, family, and fools. So, I know it's a bit silly, but the whole point is that when you're starting out in business, when you're not yet post-revenue, when you're literally not even a startup per se, when you've got no traction, you're literally looking to be seeded, the risk is tremendously high. We're talking about a 90% failure rate. So that's where the fool's part comes in, because not many people are willing to invest in an entity that is completely non-existent. And of course, one of the last and most important source, really, I haven't mentioned it here, is your own savings. And this is something that people have to consider when looking at sources of finance. And these are the ones that currently exist. I want to spend more time on the alternative sources of funding, because these are my favorites. These ones add enormous value, and these are the ones that we hope in the very near future will become more prevalent in our market and become more established. So what are these alternative sources of funding? We'll start with angel investors. Angel investors are wealthy individuals, or at least individuals with some sort of disposable income or cash available to invest in businesses in their own personal capacity in exchange for shareholding. So when these investors invest, say Susan has a avocado processing plant. She needs $10,000. Doesn't have anything, maybe has a farm, has a few things, goes to an individual and says, listen, I've got this opportunity, it's great. It's really appealing to the personal, sort of connection with that individual. That individual may pledge that money in exchange for maybe 50% shares in the company. And ultimately, this is, and when I talk about their priorities, is one, they might have a care for the person that they're investing in. So maybe they want them to do well. So maybe that's the first objective. The second objective is they want to make an impact, a personal impact. Usually is a wealthy individuals who want to feel good about themselves by making funds available to businesses. And last, of course, they want to make money, right? It's if a business becomes a great success and the valuation, $10,000 turns into $50,000 later in terms of the value of that person's shareholding the business, and they can exit or sell their shares at a later stage, maybe to a venture capital or another entity. It means that it's been a good investment. So that's what angel investors look for. That's what they are in simple terms. Moving into venture capital, usually interchangeable with private equity, very similar to angel investors, but instead of being individuals, these are institutions. These are well-regulated institutions where you've got a fund manager like ourselves, like Kukula Capital, that has a fund that they manage, which usually they put in a bit of their funds and pull in resources coming from various sources, usually other institutional investors, like insurance companies, also wealthy individuals, family offices, development finance institutions, pension funds. They give venture capitalists money, essentially to have a short-term shareholding in a portfolio of companies that the fund manager then looks to invest that money in. And typically, that's why we mentioned the equity part. It's you get shareholder. When you invest in those companies, you're not particularly lending to them. You're essentially acquiring shares. And typically, what venture capitalists do is that they get a board seat, so they've got some oversight, some participation in governance. They have some sort of a say, not necessarily on management, but have some level of involvement. That's depending on the agreement that exists between the investee company and the fund manager. And the goal is to really grow the balance sheet, is to acquire assets that enable the businesses to scale, to earn more revenues, to grow, so the venture capitalists, funds that are sitting in the business become more valuable by virtue of the valuation of the business growing. This is a very important element in venture capital, is looking at a business when it's valued at X million dollars or less and enabling it to become more valuable. That's what we call capital gains. And of course, you also earn income from dividends and other fees that come from that particular company, depending on the value that you bring to that company. And the goal of venture capitalists is really to exit that business. This is selling their shares, whether to another VC firm when it's growing even higher, or perhaps selling the whole business to a competitor so it's amalgamated into another strategic space, or maybe the founder of the business saying, hey, look, I'll just buy you out because we made so much money. And so this is how venture capitalists. Development finance institutions are very interesting. They typically invest in venture capital firms, but they also participate directly in companies. These are much more concerned with development. They do want to make a return, don't get me wrong, but they're very impact oriented. They want to stimulate, local economic activity. They want to make sure that, there's growth when it comes to jobs and so on. And that's why the development essence is in the title, right, in the name. But these are also backed by governments. So you find that DFIs, this is what development finance institutions are, you find are either owned by, so for example, the UK has CDC, France has Proparco, Netherlands has FMO, there's Norfund in Norway, and many others. So mostly wealthy countries have DFIs, and also not so wealthy countries. Even here on the continent of Africa, there's the South African development, I forgot the exact name of the entity, but it's a DFI. So those institutions really want to catalyze growth in certain sectors and make a return while doing so. And they're quite flexible in looking at various things, but their parameters are really around really large-scale development. Trade finance facilities, also very interesting. These can be almost similar to, I won't call it micro lending, but SME lending. Not necessarily where they lend to provide working capital or lend to maybe for you to acquire assets like for your capital expenditure, but they like to provide funds for transactions. Say I've got a deal where some guys out of Kenya need sugar, and I've got the order, and I can prove to these trade finance institutions that, look, all I need is access. I need to go to Zambia Sugar and get $1 million worth of sugar, but I don't have the money. But on the strength of the order, they can facilitate the trade, ensuring that the insurance is in place. It's all those factors, having LCs in place. I don't want to get too technical in the jargon, but they help facilitate transactions, whether it be cross-border or even internally within, as long as you've got an order or there's a transaction. So they usually do they provide financing per transaction, which is quite helpful to SMEs. And the last but not least, I call it soft capital, right? This is not the formal term for it, but it's money that's very, I would say it's soft. It's like getting money from your grandmother, and these are typically entities that are also somewhat government or cooperating partner funded. We're talking challenge funds, entities that provide grants. So let's say, a certain government somewhere wants to provide aid to another country. So they feel like, okay, we can provide aid and we can help SMEs. So we'll give a grant of X amount. So guess what? What's great about a grant? You don't have to pay back. Use the money, hopefully use it wisely, and it catalyzes the growth in your business without you having to have the burden of looking to pay back. Or two, they lend you, but a very, very minimal interest rate, or sometimes no interest at all, just to hold you accountable, to keep you motivated to perform. So that's what soft capital is all about. And you might say entities like Prospero have been quite an enabler of such facilities. And let's go into a bit of the pros and the cons, right? Depending on where you are, angel investors may not be right for you because it's just an individual. They may not provide what we call smart capital. If it's just a rich person who can sign a check and give you the money, and they don't have much knowledge of governance, the good thing about having institutional investors investing in you is that they're invested in the growth of the business. I mean, they're going to deploy, entity elements within their system to make sure that you're scaling, that the balance sheet is properly structured, that they're, strengthening your governance and all those factors, right? And that you're gaining as much strategic, I'd say, facilities for them, right? Resources and the like. DFIs, the problem is the funds that they provide are too big. Not many SMEs can get DFI money. Minimum is probably $5 million. So you have to be a generally larger SME to get DFI money. And of course, the conditions can be stringent, and they also like strategic sectors. I like VC. I'm biased because I'm a VC. So we're smart capital. We're involved. Right strategy. We handhold as well. In addition to providing the money. So this is why we call it smart capital, and it's patient too. So it sits. I mean, obviously, you don't have the burden of paying back. In some cases, we mix debt and equity, but for the most part, you're sharing the risk with the SMEs. Trade finance facilities, again, you need to have transactions going. I mean, of course, and the good thing is no need for collateral and all these other things. It just, the collateral, the security really is sitting in the transaction itself. And, and it's I won't say easy to get, but it's they're quite available should your transactions be well structured, so to speak. Like you've got a good off-taker, a good supplier, and you're the person in the middle. Trade finance is free. And soft capital, nobody can say anything bad about soft capital. It's like free money, right? So those are the pros and cons about the alternative sources of finance. Now, a very important point is, how do we, sorry, that's me, it's just telling me, sorry, excuse me, my alarm was just telling me that, okay, we're on track. So no worries, we still have 15 more minutes. Now, you've heard a bit about these alternative sources of funding. I've told you about the existing sources of funding. How am I going to be attractive as an entrepreneur to venture capital, to DFIs, to any of these entities? The way I can be positioned to be attractive is if I tick the boxes. These entities are very interesting in the sense that, they love the way they like things to be structured in a very specific way, in a very clear way. So I want to share with you very simply and very basically ways in which you can be attractive for venture capital and all these other sources of finance. And if you can tick all these boxes, then you're in the game. You're going to get that money. It's going to be very difficult for anyone to say, you're not going financing. The first thing, so before I continue, let me see, I'm getting notifications. Let me just make sure that we are okay. Okay, so we'll switch to Q&A in 5 minutes. That's good. Excellent. Questions, please? Okay, good. Yeah. Now, ticking the boxes will make it nice and brief. You need to have a solid and scalable business model. What does this mean? Solid just means, there's clarity in the manner in which the value proposition is created, because ultimately value is what people exchange money for. And how much of that value can you create that's what scalable is all about. Like, you have to be in a situation where money is all that's missing. This business is on point. You've got a great market. You've got a great solution to a problem that exists in the market. And that's what makes a business model solid. But of course, you also need to have the systems in place that enable for the appropriate unit economics, that the factors of production, so basically your cost structure, enables for there to be revenues or a revenue model that allows for you to have a surplus, because a business has to be profitable, right? That's what makes it sustainable in the long run. So scalability is all about its ability to grow. How much more revenue can this business generate for every extra dollar that's invested into it? That's what that's about. So you have to prove that. You have to get good at articulating that in the most simplest way. You need to have financial statements. You need to be able to articulate where have you been financially and where are you going. Like, that's how we gauge, how can we sort of model in our input, our impact on this business. Having monthly management accounts up to date, it also keeps you on track, keeps you on top of things. And then in addition to that, having annual audited accounts, right? Like, we only invest in companies that, of course, we've done a few exceptions because the businesses were so good, where we didn't look at an audited financial, but we kind of waited to say, let's have your financials audited, so we know, we can ascertain for a fact that your business's financial position is strong. And even if your business financial position is not strong, just know that maybe the only thing that was lacking was the capex that to go on your balance sheet to enable you to access the assets that make the business make money, and even working capital. All these things are necessary for a business to grow. Another thing is governance. You need to have oversight. You need to have a parent in the room, right? And like, we as Kukula, we're partners, right? We're young entrepreneurs, but we've got the board who makes sure that, hey, we can't do this. We have to stay within the right ethical parameters. We have to comply with statutory expectations. We have to maintain good, a strong financial track record. We have to have another strategic oversight. We have to mitigate risk. Those are factors of governance, right? You need to have that in place. Management is key, having people in place that perform day-to-day management roles, and you have to have a show of competence in management. You have to be able to articulate that this is who we are and why we are the right people to scale this business. Another thing is traction, showing that you are moving, that even if your business is not off the ground, but you've created something that takes it as close as possible to being an existing business, going concern, or whether or not you've raised money, or you've put in a bit of money, or you've acquired certain assets, or you've acquired certain clients. You need to illustrate that. You need to have your skin in the game. What does this mean? This means, you've like, I put a significant amount of my personal savings in Kukula. That's my skin in the game, showing that. So if an investor's putting money in Kukula, they know that, man, this company needs to work. This guy's his entire life savings out here. So that's really illustrating that you've got something to lose if the business fails. So put your skin in the game. The last point is a clear case for the capital requirement. I've been in situations where people come and they need capital, but they don't even know how much they need. They'll say, maybe $1 million. I'm like, what do you mean maybe? Like, you need to understand, like, if you're in, let's say tomato processing, you do tomato paste, be clear, we process X tons of tomatoes, the market needs X, Y tons. In order for us to do this, we need machinery that costs X and Y and Z, your CapEx, your working capital, all those factors clearly laid out. So you know specifically what you need. And it's a better case. People love clarity. That's what capital loves. So let's move into Q&A. I am told Q&A is next. So, so any questions, I'll be happy to. I don't know if these questions will be, do I have to read them, or I'm trying to see here. If everyone has any questions, type in the box. Okay. So I should be switching to, okay. I'm looking for questions if you have any. Any questions so far? Or okay, I see a file here. I don't know what that is. Okay. I'll give it a couple of moments. If anybody doesn't have any questions, we can, let's see here. Okay, I see 2 new messages. Ticking the boxes, misses perhaps something about impact. Yeah, good point, Armin. But you see, the thing about impact is that people are caring a lot less about impact. And I'll tell you, because we've invested in, I'm not saying ignore impact. Impact should be part of the equation. It should be as important as management, as governance. Very important. The thing that's even more important now is the issue of the solidness, this viability, the scalability. That's more important because it's about sustainability. Because I'll tell you another secret. The African growth story when it comes to private equity has been a very disappointing one. If you look at the last few years, you look at the IRR, right, the return, the key return on investment for private equity, it actually was outshined by sort of not the other markets, not emerging markets, but even developed markets like the US and Europe have far exceeded. So Africa, from a risk return perspective, lately has become a lot more risky. Obviously, currency issues and so on. So there's a greater degree of concern of, great, impact's good, yes, let's have metrics to measure how many jobs you create, how much you stimulate the social environment, how much of the environmental piece are you paying attention to. In fact, they should even go without saying. But the other element is, that's almost, they really looked at it as a given, like that should be there. You look at it more so from what's excluded. You don't want to be doing this that's somewhat perceived to not meet the ethical and moral expectations of finance. Like most development finance wants things that are not associated with sin industries and the like. When I say sin industries, we're talking hard liquor, gambling, things like that. So, but it's a good point. Emphasize it, right? But it will not break the case. If it's not there, it won't break the case. If anything, it's like a cherry on the cake, right? So let me see. I have another question.
Yep. Can I just interject there for a second? Such a great presentation. Sure. Obviously, so I work for Impact Capital Africa, so I'm very biased towards impact. The only thing I would just clarify with what you just said is, you're absolutely right. Financial governance and secure business operations need to form the foundation of what you do. Otherwise, you're not going to have a successful business. That said, I would argue that, there's impact investors and there's conventional investors. And, so for conventional investors, you could even disregard impact. As you said, maybe the cherry on the cake. But if you as a small business are looking to pursue impact investment because you have a strong impact angle and an impact story, then it's not optional. It has to be a core component of what you're doing.
Absolutely.
So, and one day I look forward to meeting you in person because I'd like to debate this.
Absolutely, we have to.
There's an evolving school of thought. There are more and more smaller investors, individuals, part of pension funds that are taking a more impact-oriented approach. I would agree with you, though, that especially in the short to medium term, is, definitely if you have an impact angle, that's great. But I think for a lot of the small businesses that are part of this conference or part of this event, which is right, you should focus your energies on ensuring that your financial due diligence and your ability to present to an investor across the whole investment spectrum, if that's what you're looking for, then you shouldn't worry so much about an impact. If you are looking for impact investors, very important.
Absolutely. Thank you so much, Tiffany. Really, I look forward to meeting you as well. No, yeah, I agree with you. I think it's the mood we're in right now, right? We are structured as an impact fund, and Africa, because of where we are developmentally, impact is so important. So, and most investments do ultimately generate some form of impact. I've seen a few questions. I don't know how much time we have because we need to move into the takeaways before we move into the main room. I need to just double check. Oh, 1 minute. Okay. You know what? Let me just close this off. I'm sorry if we can, make a plan another time. Let me just move on to the last point, which is the way forward. Now, from a way forward perspective, my advice to you is build competence. I'll try to mix in some of the questions in here, the answers to questions. Build competence, know your business model, stay focused, right? The more you know your business, the less likely you are to stumble, right? Like there's a certain excitement that investors love to see when they see competent people. Remember that action leads to traction that builds attraction. Very important. Focus on action so that you get traction and you attract capital. Capital seeks security, clarity, value, and yield. This is just what capital wants. It wants to go somewhere where it's safe, where it's not going to be lost, where there's a clear business model that is going to create value, create impact, at the same time it's also have yield, make a return. And build your capital network. Get to know the local investors. Don't just apply to an entity, apply to, let's say a company, right, to borrow money. Like, get to know who's who in this market, right? Is this Jito, is Njava, is this guy, that guy, or this lady, that lady, all sorts of people, right? And just understand, build relationships. Of course, tick the boxes. I already shared those boxes. This will be shared with you, so you'll be able to look at it later. And remember, you need to be patient. It is not personal. It's just business. When it comes to money, right? When it comes to getting invested capital, there's people I've not said no to. I used to say when we're not interested in investing in something, I said, no, we can't do this. But the most important answer is not right now, because you're not yet ready, because you have to tick the boxes. So it is not personal. And just go back to the drawing board and keep working. So you guys want to continue to engage with me? I'm on Twitter.